Hi, morning again. Okay, I think this is it. So welcome to our session. So this will be revision then for test 1. So just quickly, I'm Miss LZ Rothman and I'm from Pretoria campus. So in the chat, I'm also going to just put my email there so that you can email me as well if you want to. But the session are being recorded. So the recording will be posted on our YouTube channel. And then also the slides that I use today will also be shared with your lecturers, and that will also be posted then for you. Okay, so you will have access to the slides as well as the recording. I'm just quickly going to type my email there. Okay, so there you go. So if some of you want to send an email after the session to ask for the slides, you're welcome to do so. I would recommend, if it's possible, if you can just do it like one student per campus maybe. And then you can also share it amongst all of you. Okay, so if you want to do that, you're more than welcome to do so. Okay, so I planned to do the 2025 paper then for today. We'll see if there is time. We can maybe have a look at the 2024 paper as well. I have the memo for both of them. So let's just see what time will allow. And then just one other thing, I'm going to share my screen so that you can also see where I'm going. And then if I share my screen, I can't see the chats. So you're welcome to put something in the chat if you want to ask something. Otherwise, you're also welcome to just unmute yourself. And then if you interrupt me, that's fine. Okay. In the chats, I will come back to that, but I might not see it at the moment that you need to ask something. Okay, so I'm going to share my screen and then we can start. Okay, there we go. Okay, so I do it like this, then I think it's big for everyone to see. Okay, so this is then test 1 for 2025. And I don't know if any of you maybe had a look at this paper, but you'll see there that question 1 was true or false questions. So they ask you there, for each of the statements below, you are required to state if the statement is true or false. In your answer booklet, write down only the number and next to it state true or false. If you state both true and false, no marks will be awarded. And if your answer is false, you are required to state the reason why. Okay, and that part is very important. If they tell you something like this, if your answer is false, say why or explain or something like that, then the memo tells the marker that if the answer is false, without any reason, you're not allowed to give any marks. Okay, so please give a reason. Even though it might be that your reason is wrong, we can still award the mark for the false. But if you have false without any reason, then the false can also not get a mark. Okay, so please make sure about that. Okay, so if they tell you, if your answer is false, you are required to state the reason why, then please make sure that you do state the reason why. Okay, so 1.1, they tell us that a temporary difference refers to the difference between the carrying amount of an asset or liability in the financial statements and its tax base. Okay, so 1.1 is true. Okay, that temporary difference is the difference between the carrying amount and the tax base. Okay, then 1.2, they tell us that the tax base of revenue received in advance is the carrying amount of the underlying item less the revenue taxable in future periods. Okay, and that's false. The tax base of revenue received in advance is the carrying amount of the underlying item, but it is less the revenue not taxable in future periods. Okay, so 1.2 is false. It's the revenue not taxable in future periods. Okay, then 1.3, they tell us the tax base of an asset is dependent on whether the future economic benefits are taxable or not. And that's true. Then for 1.4, they ask us a deferred tax liability or asset can be recognized for taxable or deductible temporary differences which are exempt. And that's false. The deferred tax liability cannot be recognized for taxable temporary differences which are exempt. Okay, so 1.4 is false. It cannot be recognized. Okay, so I just quickly want to jump to the... Okay, there's no questions yet. Okay, then 1.5. A taxable temporary difference of a liability occurs when the carrying amount of a liability in the financial statements is less than the tax base, resulting in a future deductible amount. That's also false. A taxable temporary difference of a liability occurs when the carrying amount of a liability in the financial statements is more than the tax base, resulting in a future deductible amount. Okay, so it's not less than the tax base, it should be more than the tax base. Okay, I'm going to jump back to this just now. So you will see just after the question, I did put in the solutions for you as well. Okay, so we said 1.1 is true, 1.2 is false, 1.3 is true, 1.4 is false, 1.5 is also false. Okay. Then at 1.6, they tell us the current tax payable includes the deferred tax amount of the current reporting period. That's also false. The current tax payable does not include the deferred tax of the current reporting period. Okay, then 1.7, in the statement of financial position, your current tax receivable is presented as a current asset. That's true. 1.8, your penalties and interest paid in respect of tax payments are not included in the tax expense of an entity. That's also true. Then 1.9, an assessed tax loss is the amount by which the tax deduction exceeds the taxable income of a company for a particular financial year. That's also true. And then lastly, 1.10, SARS is liable to pay a company if a company has incurred a tax loss during the financial year. And that's false. They are not liable to pay a company. Yeah, because if they incurred a loss, it will just be deducted in the next year or whenever they then do make a profit. Yeah, and then you'll see I've also included the solutions for you for 1.6 up to 1.10. Yeah, any questions on question 1? Okay, I see there was a bit of an issue with the sound. Okay, I hope everyone else can also hear me. Okay, perfect. Okay, then we can move to question 2. Okay, and then question 2 was 40 marks. Okay, just quickly something that I just want to mention in case you might forget. So just remember, it's only from last year that the questions were out of 50 marks. Okay, so if there is maybe some of you that will go and do, let's say, question or paper 2024 and 2023 and so on, just remember then it was actually still 60 marks. Okay, so just remember that. So luckily this one was also only 50 marks and your paper this year is also only 50 marks. Okay, so question 2 They tell us that PC Global Limited is a technology company that designs, manufactures, and sells consumer electronics and computer software. The company is listed on the JSE Limited and has a 31 December reporting date. You, as an expert on the principle contained in AIS 12 income taxes, have been appointed to assist the accountant with the finalization of the company's financial statements for the year end 31 December 2024. You have been provided with the following information. And then they give you the deferred tax balance on the 31st of December 2023. And this is very important. They ask you, they almost in the last sentence in that first paragraph, to do the statements for the year end 31 December 2024. And then they give you a deferred tax balance on 31 December 2023. So now you need to know that this is an opening balance that they are giving you. Okay, so we have a deferred tax opening balance. Okay, then number 2, on the 15th of February, the Minister of Finance announced on the budget speech presented in Parliament that a new tax rate of 27% will be applicable to all entities with years of assessment ended on or after 30 April 2024. So there we can also see that there's a change in the tax rate. Okay, because just on the previous slide, they tell us that the tax rate applicable on that date was 28%. There at number 1. And now at number 2, they tell us there's a new tax rate of 27%. Okay, so we need to remember that we have a change in the tax rate. Then during the year ended 31 December 2024, they received dividend income from Mousetrap Limited of 80,000. The dividend received is not taxable. Okay, remember if they tell you it's not taxable, meaning it's exempt. Then number 4, on the 31st of December 2024, they had a prepaid insurance balance of 654,000. Then they also give you the opening balance. And they tell you that prepaid expenses are deductible for tax purposes at the earlier of payment or accrual. Then at number 5, during the year ended 31 December 2024, they undertook a project to develop a new cloud-based accounting software package that integrates with ChatGPT. PC Global incurred research cost of 170,000 and development cost of 149,000 in respect of the project during the year ended 31 December 2024. Development costs amounting to 123,000 met the requirements of paragraph 57 of AIS 38 intangible assets and were correctly capitalized. The new accounting software package was available for use as intended by management on the 1st of May. The capitalized development costs are amortized on a straight line basis over an estimated useful life of 10 years with no residual value. SARS allows 150% of all research and development costs as a deduction when incurred. The correct calculations of the carrying amount of the capitalized development cost on the 31st December is available as follows. Then they give you the cost, they give you the amortization, and there's a new carrying amount. Okay, then at number 6, they tell you what trade receivables consist of. So there what's important is we use the allowance for expected credit losses. Okay, that's the important one for us. The allowance for expected credit losses as at the 31st of December 2024 qualifies for the 40% deductions under the Income Tax Act. And then they tell you next to that, the allowance for expected credit losses as at 31 December 2023 qualified for the 25% deduction. Then number 7, PC Global owns a factory building. The carrying amount of the building on the 31st of December 2023 and 2024 correctly calculated by the financial accountant was 1.4 million and 1.2 million respectively. Okay, just remember, if they give it to you like this, the first date will go with the first amount. So on 31 December 2023, the amount is 1.4 million. And then on 31 December 2024, the amount is 1.2 million. Okay, so the first date will go with the first amount. There have been no additions or improvements to the factory building since it was acquired. The tax base of the factory building on the 31st of December 2023 was 1,280,000. SARS allows a deduction of 320,000 Rand per year in respect of this factory building. Then at number 8, they also own an office building that it purchased during the year ended 31 December 2024 at a cost of 2.5 million. The depreciation for the year ended 31 December 2024 on this office building was 125,000, correctly calculated by the financial accountant. And then, very important, no tax allowance are granted on this building. Okay, so remember that depreciation for buildings can be exempt. Okay, so you'll see at number 7, where they have a factory building, it's a temporary difference because they tell us what's the carrying amount, what's the tax base, all of that. But then at number 8, they tell us that there's no tax allowance granted on this building, meaning this depreciation will then move to your exempt differences. Okay, then number 9, during the year ended 31 December 2024, they began to present computer training courses. On the 1st of December 2024, a cash amount of 250,000 Rand was received for a training course that would take place on the 1st of January 2025 to the 31st of March 2025. Revenue is taxed at the earlier of receipt or accrual. Okay, so they have income received in advance there. Then number 10, current liabilities include revenue received in advance of 250,000 and accrued bonuses amounting to 300,000. The revenue received in advance will be taxed during the year end 31 December 2024. The bonus will be settled on the 31st of January 2025. And as the bonuses are not contractual, will only be allowed as a tax deduction when settled in cash. Then at number 11, they tell us what the accounting profit before tax was. And this is also after taking all of the above information into account. Then at number 12, they give us the taxable income for the year. And then number 13, there are no other items giving rise to temporary differences except those arising from the information given. And then they ask us at 2.1 to calculate the deferred tax balance as at 31 December 2024 using the statement of financial position approach. Clearly indicate for each temporary difference whether the deferred tax is an asset or a liability. Indicate whether the final balance is a deferred tax asset or a deferred tax liability. Use the following table format. Okay, so remember, when we need to calculate deferred tax, we focus on temporary differences. Okay, the asset and liabilities of the temporary differences. And then normally, I like to group them together. First, I do all the assets. Second, I do all the liabilities. So that I can remember, if it's a liability, it's a negative figure. But you will see on my memo, I sort of tried to stick to the question and I did it in that order. And the reason is just to show you that within that table, the order doesn't matter. Guys, it doesn't matter whether you first have, let's say, prepaid insurance or whether you first have your building, whatever the case might be. Okay, so it might be that my order is slightly different, but that's okay. Okay, so let's look at this. Okay, so this is the table that you can use. So in the first column, I've just put the year there for you. Okay, so then we have the carrying amount. So the carrying amount, remember, that is what the company calculates. Okay, especially if it's on something that depreciates, the carrying amount will be your cost minus your depreciation or your accumulated depreciation. Then the tax base is what SARS allows. Okay, it's still your cost, but then minus whatever SARS allows. Then we get the temporary difference. And that temporary difference is the difference between your carrying amount and your tax base. And on that temporary difference, we calculate deferred tax. And that deferred tax will then be at the current tax rate. Okay, so that tax rate, it's always important to just make sure what the rate is in your question. Okay, currently, the income tax law states that it is 27%. But remember, the questions can be sort of a fiction question. So they can tell you that in this year, the tax rate is 30%, for instance. Okay, so don't assume that it's always going to be 27%. Refer back to your question and make very sure that that is the case. Okay. So the first one I have there is prepaid insurance. So you'll see the easiest way for me to do this is for temporary difference, I always take the carrying amount minus the tax base. Okay, always carrying amount first, whether that's the bigger or the smaller amount, doesn't matter. It's carrying amount minus tax base. Then you get your temporary difference. Then for me, the easiest way to remember this is when I calculate deferred tax, I change the sign for the temporary difference. So if my temporary difference is a positive, my deferred tax will be a liability. Okay, so remember they asked you to calculate or to show whether this is an asset or liability. Okay, just please make sure you are all muted. Okay, if you want to say something, please, you're more than welcome to. Otherwise, just make sure you are all muted. Okay, so then from your temporary difference, you change the sign so that if your temporary difference is a positive, your deferred tax is then a liability. Okay, so the question asked us to specifically show whether it's an asset or liability. So you can also, if you want to, keep your amount positive and next to this, then just write liability. Or if you put this in brackets, then we know, okay, this is a liability. Okay, so prepaid insurance was given to you in the question, the 654,000. And then we have a liability deferred tax on that. Okay, then next we have development cost. Okay, that development cost, I'm quickly going to jump back to the question. They're at it was part of number 5. So they tell us that there's research cost and there's development cost. And then they give us the calculation for the amortization of this cost that was capitalized. And if that happens, this is a temporary difference. And then we use the carrying amount. Okay, because remember, for temporary differences where we calculate deferred tax on, we need the carrying amount minus the tax base. Okay, so we use this 114,800. Okay, so it's very important if it amortized, then it's moved to a temporary difference and not exempt anymore. Okay, so then we put in the 114,800. Then for that, there's no tax base. And then your deferred tax is also a liability. Okay, then next I have allowance for credit losses. Okay, they tell us in the question at number 6, let's quickly jump back. There's your allowance for credit losses for 2024, so that's 112,000. But then for SARS, they tell us that they qualify for a 40% deduction under the Income Tax Act. So meaning your tax base is calculated at 60%. Yeah, I did include the calculation there for you. So you'll see 112,000 minus 112,000 times 60%. Okay, and then you'll see, remember, this is in brackets because this is a liability. So that's the way that I do this. And then just we said that carrying amount minus your tax base is a temporary difference. But remember, if you have a negative minus a negative 44,800, this 44,800 actually becomes a positive. Okay, because a minus and a minus gives a plus. So then your temporary difference is a 67,200. This is negative. So now we change the sign for deferred tax. So then your deferred tax is an asset on this. Okay, then we have factory building. Okay, so remember the factory building was still a temporary difference. And they give you, let's just quickly jump back to that again. Oh, sorry. Okay, they had number 7. They tell you regarding the factory building. There they give you the carrying amount, the 1.2 million. And they tell you the tax base of the factory building on 2023 was 1.28 million. And then SARS allowed 320,000 per year. Okay, so they didn't give you the 2024 tax base, but we can calculate that. Okay, so there we have the 1.28 million minus 320,000. And then again, your deferred tax will then be a liability. Okay, then you'll see on the memo for the office building for last year, they actually did include that on the memo. But then you had to say exempt. Okay, so you will see, I think there is one example in the textbook that also does it like this. But last year, we as lecturers decided that if a student didn't include the office building, they obviously knew that it was exempt, so you didn't lose any of the marks. Okay, so the same will then be this year as well. If you just do not include office building because it's exempt, it's not a temporary difference, then you won't be penalized on that. Okay, we will still give you the marks. Okay, I'm just putting it in there that you can just see what the memo wanted last year, but the students that didn't include that at all were not penalized. Okay, and the same will be this year. Okay, because we actually don't lecture you to do it like that, because that's not how any of the other questions are done. Okay, but just so that you take note of that. Okay, then we have revenue received in advance, 250,000. Remember, that's a liability. That's why it's in brackets. Then lastly, we have the bonus provision. That's also a liability. So again, in brackets. Okay, and then lastly, a balance of everything. Okay, so you'll see that balance is also positive, meaning it's an asset. Okay, but as I said before, you can keep everything positive if you want to, but then next to that, you have to state whether it's an asset or a liability. So that was question 2.1. Any questions there? Okay, see, there is a question. Why would the tax base be 0 for development costs? So that is only because it's moved from actually being exempt to temporary difference. So that 150% that they tell us that SARS allows is actually only if it's under an exempt difference. So because it is amortized, it's moving to temporary differences, and then your tax base is always 0. Okay, and then there's also a question that just to explain the allowance for credit loss. Also, I'm going to quickly open that there again. Okay, so there, the third one, the allowance for credit loss. So normally we have the one where they have a 25% deduction. Okay, that's the one that we normally know how to do. But in this question, let's go there to number 6. They give us the trade receivable. So there's a gross amount and there's an allowance for expected credit losses. And then they tell us that this allowance for expected credit losses qualifies for the 40% deduction under the Income Tax Act. And the allowance for expected credit losses as at 31 December 2023 qualified for the 25% deduction. Okay, so if they allow the 40% deduction, we basically see it as that there's 60% that is left or is not deducted, if that's making sense. So that's why we then take the 112,000 because they didn't give us anything on SARS's side. We only have our 112,000. And then we take that 112,000, we times that with 60%, that is not a deduction. And then we deduct that from the 112,000. Okay, I hope that's making sense. And then it will look like this. Okay, because normally we just take our closing balance and we times that with 25%. But in this case, they changed that 25 then to 40%, and they didn't give us anything regarding what SARS currently have. Okay. Okay, so if it wasn't amortized in permanent differences, we would add it back to the development and less the tax allowance for development cost. Yes, that's correct. Okay, so if it wasn't amortized, then it will be exempt or then a permanent difference, and then we will add that back. Okay, yes, you are 100% correct there. Okay, any other questions? Okay, so the uncapitalized portion, you will put that to your permanent differences. Okay, so if they asked you to, let's say, do the current tax calculation, then that portion, as well as the other expenses, that will be sitting under your permanent differences. Okay, Jessica, I'm going to answer you first. Yes, we do keep it separate. Okay, so even if it didn't amortize and we had to keep it under permanent, we will also split the two. You will have your expenses as a calculation, and then you will have your capitalized portion as a calculation. Okay, then the other question, so in calculating the deferred tax balance, we include assets that don't have a tax allowance. Yes, but also the ones that have a tax allowance. So you basically include both. That will be affected under temporary differences. Okay, any other questions? Okay, then question 2.2. Let me just go back there. So there they ask us to do the journal entries to record the movement in the deferred tax account and the current tax in the financial records of PC Global Limited for the year ended 31 December 2024. Show all your workings. So remember, for accounting, as I'm sure you've seen in previous years as well, your workings are always very important. Okay, because we can always get some of the marks if we can see what you did. Whereas if you just put an amount as an answer and that answer is wrong, then it's wrong. We can't give you any marks. Then they tell us to round off your answer to the nearest rand, and journal narrations are not required. Okay. Very important when you read your question is that your narrations, you need to make very sure. Are narrations required, yes or no? Because that's actually easy marks. So just maybe make yourself a note if you read through the questions and you see that it is required, that you just remember that. Okay, because that's sometimes penalties that students get and it was actually unnecessary. Okay, so read very carefully and then make very sure whether it's required or not. Or if you want to, remember, you don't get penalized for something that's there that shouldn't be there. So if you have time, it's always best to put the narration, and then you'll either just get a mark or nothing at all if it wasn't actually required. Okay, so very important, if they just ask you the journal entries for the movement in the deferred tax account and the current tax, you need to make sure that you know what the journals are exactly. Okay, they didn't ask you journal this and journal that and do a journal for this. Okay, they give you a hint as to the movement in the deferred tax and current tax, but you just need to make very sure what exactly is the journals that I have to do if they ask us something like this. Okay, so let's first look at the rate change, because remember we said there that last year it was 28%, and then after the budget speech that was moved to 27%. Okay, so let's just quickly go there. Okay, so I did the rate change calculation like this because in the question, let's quickly jump back. In the question there at number 1, they gave us the carrying amount of the net assets and the tax base of the net assets. So remember, if you say carrying amount minus tax base, you get your temporary difference. And on that temporary difference, you can calculate deferred tax. Okay, so they didn't just directly give you the opening balance, but you are able to calculate that opening balance. Okay, so let's quickly have a look there. Okay, there we go. Okay, so that carrying amount is given to you in the question, the 7.5 million. The tax base is given to you, 5.2 million. And then if you take the carrying amount minus the tax base, you get the temporary difference. So that's the 2.395 million. Now just remember, in that year, the tax percentage was still 28%. Okay, so then you can calculate deferred tax on the temporary difference, and then you get 670,600. Okay, now we use that 670,600, which is then your opening balance, to calculate the rate change. Just going to go to the next slide so that you can see the calculation. So there is other ways to do this as well. For me, the easiest is you take the opening balance, so that's the 670,600 times, and then the 1 is by how much the percentage changed. Okay, so it moved from 28 to 27, so that's only 1%, divided by the old percentage. Okay, so that's where the 28 is coming from. Okay, so you take your opening balance times, so the 1 is the percentage increase or decrease. So in this case, it moved from 28 to 27, so it's 1%. And then you divide that by the old percentage, which is 28. Okay, and then in this case, since it moved from 28 to 27, so it's going down, you will debit your deferred tax, credit your income tax expense. Okay, so we can actually pay less. And then you will see, I did include the narrations for you, but mostly so that you can see what it will be if it was required. Okay, so remember in this question, they told you that narrations are not required, but I did just put it in so that you can see what it will be. Okay, so that will then be something like recognition of rate change. Okay, any questions there? Oh, sorry, I see there is a question. Okay, sorry to go back. I just like to make 100% sure with the development cost. If it was not amortized and we are calculating current tax, we would add the uncapitalized portion back and then deduct the 150% allowance. For the capitalized portion, we would only deduct the 140% allowance as it is an asset, so we would not need to add it back to the current tax as it did not affect accounting profit. Yes, that's perfect. Okay, so Regan, I hope you can hear me now. I only get to your question now. So yes, that will be 100%. Okay, so if it wasn't amortized, then that's how we do it. So it was actually only this question where I've seen that they ask it like this. So just remember, if it then gets amortized, then it's moved to temporary differences. Okay, but otherwise you're perfectly fine. Okay. Okay, any other questions? Okay, then I think let's stop there for our first break. So you can go till 9:30, then we will continue. If you have questions, you're more than welcome to ask that during the break as well. But I will only answer that then after the break, okay, so that everyone can hear the answers. Otherwise, there might be some other students that sort of wondering the same thing. Okay, so if you have questions, please, you're more than welcome to ask it there in the chat, and I will then answer that at 9:30. Okay, so we'll continue at 9:30. Okay, let's continue. Okay, so I'm sharing my screen again. Okay, so the first journal we had a look at there was then the recognition of the rate change. And then we also have to do the journal for the movement in the deferred tax and then also the current tax for the year. Okay, so let's look at the movement for the year. So I'm going to show you that journal. Okay, so remember we had the opening balance, the 670,600. But now we have decreased that deferred tax with the rate change, making that a new opening balance of 646,650. And then we minus the balance that we've calculated in that table. Okay, because we need the movement for the deferred tax. And then you get a deferred tax movement of 540,918. So we debit deferred tax, we credit the income tax expense. And then just again, in case they ask you the narration, it's recognition of deferred tax movement for the year. Okay, and then the last journal we have to do is the current tax for the year. So if you go back to the question, at number 12, they gave us the taxable income for the year. So we need to use that 5,058,956. And on that, we calculate a 27% income tax. Okay, so then that journal will be debit income tax expense, and we credit current tax payable. Okay, any questions there? Okay, and then lastly, we have question 2.3. So in question 2.3, they ask you for the income tax reconciliation to be included in the income tax note in the financial statements. No comparisons are required. The tax reconciliation should be in rands only. Okay, so they only ask you for the reconciliation. So you don't have to do that first part of the note where you have the current tax plus the deferred tax, and then the rate change and all of that. Okay, you can just do the tax reconciliation. And remember that tax reconciliation will then focus on your exempt differences. Okay, so let's quickly have a look at that. Sorry, before we do that, I just quickly want to make a change to this. There was two that I wanted to put in and then I forgot. Let me just quickly put that in for you. Sorry, just give me 2 minutes. Let's put that in there. Extra research and development. Okay, I will recalculate that balance just now. Okay, so the profit before tax, remember that's your accounting profit. And that was also given to you, I think it was number 11. Yeah. At number 11, they give you the accounting profit before tax. So remember, that's the profit that we need to use for that reconciliation. And then your tax at 27% on that, so on that specific profit. Then we had dividend income. Remember, dividend income is exempt. We had the depreciation on office building. So remember that depreciation on a building can either be exempt or then temporary. So in this case, that was exempt or then permanent. Then we have that extra research and development cost, the 50% on the part that was not capitalized. And then we have the decrease in the tax rate. Okay, I'm just quickly busy recalculating that balance for you. 21,600 plus 33,750 minus 43065 minus 23950. Okay, so then that new balance is 734035. Okay, and that was the paper for 2025. Okay, are there any questions on this? Yeah, you're all fine with the 2025 paper. Okay, then since we do have time, I will then also do the 2024 paper. Okay, see, there's a question. Where did you get the decrease in the tax rate? Let me quickly show you that. So in the question itself, if we go back, it tells you there at number 1, they give you the deferred tax balance of 2023, and the tax rate applicable on that date was 28%. And then at number 2, they tell us that on the 15th of February 2024, which was in this financial year end that we are busy with, the Minister of Finance announced in his budget speech that the new tax rate is 27%, and that will be applicable to all entities with years of assessments ended on or after April 2024. Okay, so our year end was 31 December 2024. So that tax rate was applicable for this question. Okay, then so in this paper, there wasn't an expectation to reconcile to the total tax expense in 2.2. No, they didn't ask you that. They just asked you the reconciliation portion. They didn't ask you the full tax note. Okay, I will quickly go back to the previous or to the question paper for you. Okay, so there we go. Okay, for those of you that want to maybe download the paper and then just try to do the paper, I'm going to go to the next slide. If you go to My Emeris website, okay, so that's the new website, is My Emeris. And then you'll see there's a library option. I will show you that now as well. And then past papers. So under that past papers, you will find the 2025 paper there as well. Okay, so sometimes it might be nice to download the paper or even print that for yourself and then try to do the full paper. Okay, because there's a lot of additional information that they actually give you. So for you to make sure that you can actually read through everything and make sure that you can do everything might be a good idea. Okay, so there's the required part then for this question. Okay. Okay, then there's a question. Please go back to the answers for question 1. Okay, so there's the first part of solutions for question 1. And there's the second set of answers. Okay, then there's also a question, is it fine that in this paper the amount 734035 from the recon does not balance with the income tax expense amount? Yes, because remember, you actually have to take the current tax plus the deferred tax and the rate change and all of that to actually get your total amount. So I think they just took the, let's quickly see. I think they only took the income. Sorry, was it in the journal? I just now. You referred to this amount, I assume. Okay, so remember, this is only on your taxable income. So to that, you have to either add or deduct your deferred tax and then your rate change as well. So it should actually balance. Yeah, I will quickly in the next break that we have, just quickly have a look at that. It should actually balance. So I will just quickly have a look at that. I didn't actually do that because they didn't ask you to do the full note. They only ask you to do the recon. So I will get a look, quickly have a look at that, okay? And then I will get back to you on that. Okay. Any other questions? So I just quickly want to confirm with you for that 801,050. Did you also include the effect of the tax rate change? Okay. Okay, it might be that there might then be a mistake in the paper because what happened is when we got the paper last year to mark, these last two that I've just filled in wasn't there. It wasn't in the recon. And then when we started marking, we realized that it should have been in there. But if you take these two out, you actually get the 801,050. So it might be that there was a mistake because they forget about this part. Yeah, then it will balance actually, if what I'm saying is making sense now. So the extra research and development cost and the decrease in the tax rate wasn't in the recon when we received the memo. So I think when they've balanced the two, it was actually 801,050. But then we've realized that these two should also be included. And then I think it's throwing everything out. Okay, so it might be that in this question, it's actually not going to balance. Okay, but normally it should. Okay, so you are correct to think that it should balance. It should balance. Okay. Okay, are you all fine with the 2025 paper? Okay, then we can move to the 2024 paper. Oh, sorry, I just quickly want to show you where to find the papers. Okay, so especially now since we've had a name change and all of that, so I'm not sure if all of you know exactly where to go. So if you go to My Emirates, so you'll see the website is my.emirates.ac.za. So then it will look like this. So then if you go there on the right-hand side to My Library, you go there and you go down, you'll see there's past papers. So if you go to past papers, and then this still looks the same as we had it on the Varsity College website. So we go to A, then you can choose the year 2024, 2023, 2022. Oh, it's weird that the 2025 one, I'm sure it was there. Okay, don't know where it's now, but it was there. Okay, but then you go to the year 2024, for instance, and then you just look for this module code. So there you'll see 7321. If it says E, it's exam. And then T1 is test 1. So there's the PDF and there's test 2. Okay. So there you will find the test, and you can download that and then use that. I will then share the 2025 paper with your lecturers as well with the slides, so that you have the paper separate as well. I think sometimes it's just a bit easier than to have it in this full slideshow. Okay, so the 2024 paper, so there you will see they did it slightly different, and they ask you which statement is correct. Okay, so they ask you select one correct answer for each of the following. In your answer booklet, you can only write down the number of the question and next to it the number of the correct answer. If you insert more than one answer or option, no marks will be awarded. Okay, and then they tell you that Stacey Limited has a tax loss of 350,000 Rand on the 29th of Feb. Based on the projections performed by the auditors in testing the going concern of the entity, management is uncertain if Stacey Limited will return to profitability. And then they ask you, which of the following statements is correct? Is it a deferred tax asset relating to the full amount of the tax loss should be recognized? A deferred tax liability relating to the full amount should be recognized? Or a deferred tax asset relating to the tax loss should be recognized and limited to the total taxable temporary differences at the end of the current year, or then none of the above. Okay, for this one, it was number C. So we have a deferred tax asset and it's limited to the total taxable temporary differences. Okay, I just quickly want to show you there. At the end, I did also include the solutions for you. Okay, so you will have everything. Okay, so 1.1 is C. Okay, there it's also important to just make sure what they require you to do. Okay, they can also say that which of the following statements are incorrect. Okay, so just read carefully there. Okay, then 1.2, an amount of 32,000 was provided for a lawsuit in the books of Smarty Pty Limited as the year end 30 September 2023. No other amount had been previously provided. Provisions are deductible in the year the expense is paid. And then they ask you which of the following statements is correct. An amount of 32 should be added back to the accounting profit to get taxable income in the current year. The amount of 32,000 represents an exempt difference in the current year. An amount of 32 should be subtracted from the accounting profit to get the taxable income. Or then in future years, the amount of 32,000 will not be included in the accounting profit, but SARS will allow the deduction, giving rise to a deferred tax liability in the current year. Okay, that's number A. That 32,000 should be added back to the accounting profit to get the taxable income for the year. Okay, then 1.3, with reference to IAS 12 income taxes, taxable profit is defined as. Okay, now sometimes it might be better to, in your head, sort of first think what the definition is before you read through everything. Okay, think what's the definition of a taxable profit, and then you can sort of see if you can find that in your answers. Because sometimes after you've read through everything, now you are also unsure of what this actually is. Okay, so taxable profit is where you need to calculate the current tax on. Okay, so it's a profit. Number A, it says it's a profit for a period determined in accordance with tax rules upon which the current tax is determined. Okay, to me that sounds perfectly fine. Or the profit for a period determined in accordance with tax rules upon which the tax expense is determined. Okay, taxable profit is going hand in hand with current tax. Then number C, the profit for a period determined in accordance with IFRS upon which income taxes are payable. Or then the profit for a period determined in accordance with IFRS upon which the tax expense is determined. Okay, so that's also number A, because this is regarding tax rules and not IFRS. Okay, remember IFRS is international, whereas tax rules is more country specific. Okay, so that's number A. Then 1.4, at the end of the current year, Max CC has accrued expenses with a carrying amount of 13,600. The accrued expense or deductible when incurred, the rate is 27%. Which of the following is correct? Okay, this is also something sort of that you can, I want to say, think in your mind what's going to happen. Okay, so the tax base is 0. Deductible temporary difference is 13,600 and a deferred tax asset of 3,672 results. Tax base is 0, no temporary difference, no deferred tax. Tax base is 0, a taxable temporary difference of 13,600 and a deferred tax liability results. Or the tax base is 13,600, no temporary difference and no deferred tax result. Okay, so this is number D. Okay, it's accrued expenses. So your carrying amount and your tax base is the same. Then there's no difference and no deferred tax. And then the last one there, 1.5. Cullum Limited purchased a piece of land on the 1st of June 2023 for 1.8 million. The company's new office will be constructed on this land. The company accounts for land according to the revaluation model. On the 31st of December 2023, the fair value was 2 million, the tax rate 27%, and 80% of all capital gains are taxable. Okay, so again, it can be that you can sort of sort this out in your head. Okay, they give you a fair value of 2 million and to purchase the land was 1.8 million. So there's a 200,000 temporary difference already. Now you just have to sort out, is it a tax liability or is it a deferred tax asset? Okay. And then also, will it be a deductible temporary difference or a taxable temporary difference? Okay, so in this case, it will be a deferred tax liability and a temporary difference. Okay, so it's number B, a taxable temporary difference of 200,000 and a deferred tax liability of 43,200. Okay, any questions there on question 1? Oh, sorry, I can quickly do that before I ask the questions. Okay, so 1.1 is C, 1.2 and 1.3 is A, 1.4 D, 1.5 B. Hi, any questions on question 1? Okay, then question 2. Okay, so just remember again that the 2024 paper were out of 60 marks. Okay, so just bear that in mind. So there they tell us the following information relates to VRX Technologies, a company that develops immersive virtual reality gaming systems and accessories. The information relates to the 2024 year end. Okay, then they give you extracts from the financial statements. So you can see there's depreciation, there's fines and dividends. They tell you it's not tax deductible. Then we have a first and a second provisional payment to SARS. Okay, this is also something that we didn't really see that often. Then we have insurance paid in advance, rent received in advance, there's an allowance for credit losses, and there's a deferred tax liability. Okay, then additional information. The 2023 tax assessment was received on the 15th of Feb, reflecting assessed current tax of 360,420. The current tax provided by the accountant amounted to 345,600. Okay, so what happened there is when the accountant calculated the taxes, they got that we need to pay 345,600. Then SARS goes, they reassess or recalculate your taxes, and now they got 360,420. Okay, so there we have what we call an under or over provision. Okay, so we've under provided because we've provided for 345,000, but in the end it was actually 360,000. Okay, then number 2, they give you the accounting profit before tax after taking into account the above mentioned items from the extract of the financial statements. Number 3, SARS allows a building allowance of 80 and a factory buildings and wear and tear allowance of 46,000 on machinery. Then number 4, SARS does not allow any deduction in respect of the office building. So again, their office buildings will then be exempt or permanent difference. Then number 5, the allowance for expected credit losses qualifies for the 25% deduction in terms of the Income Tax Act. Then number 6, the machinery was sold for 402,500, inclusive of VAT at the date of the sale. The machinery had a carrying amount of 200,000 and a tax base of 260. Profit or loss on the sale was included in the net profit for the year. Then number 7, receipts are taxed by SARS when received, and payments are allowed as a taxable deduction when the payment is made. Tax rate was 27% for the past 2 years. Okay, so we do not have any rate change there. There's no other temporary or permanent difference other than those stated above. And then at the required part, they ask you to do the current tax expense calculation. Then at 2.2, using this information, prepare all journal entries affecting taxation in the financial records. And then they give you a hint. And these hints are there for a reason. So please don't ignore them. They tell you that your journal entries should include any provisional tax payment made to SARS during the 2024 financial year, the recording of the current year taxation expense, as well as the current year movement in the deferred tax balance. And then narrations are required. And then 2.3, they ask you to prepare the income tax expense note, including the taxation reconciliation for the year ended 2024. No comparisons are required. Tax rate should be in rand, because remember, sometimes they can ask you percentages as well. Okay, so just be careful of that. They can ask you percentages as well. So they tell you the reconciliation should be in rand, but then they ask you, what is the effective tax rate? So that's calculating the percentage. Okay, but we'll look at that now. Okay, so let's look at the current tax expense calculation. So that's where you start with your profit before taxation. Okay, they've given that to you in the question, 1.76 million. Okay, and then remember, after that, we have the exempt or then the permanent differences. Okay, that should be the next option that you have. And then you go to your question and you see, okay, what is that? Okay, so normally it's dividends, it's fines. If I talk about the research and development cost where it's expensed, that will go there. Or then when it's capitalized but not being amortized, okay, then it's also there. Okay, so in this specific question, we had depreciation for the office building, the fines, and the dividends received. Okay, the fines and dividends and the depreciation is all on that extract from the financial statements that they've given you. Okay, then after you've done all of that, then we have the temporary differences. And also remember the under your exempt differences, the order doesn't matter. Okay, if you have fines and dividends first and then depreciation, whatever, that's fine. Okay, as long as you have the exempt differences above the temporary differences. Okay, then under temporary differences, the first one we have there is depreciation. So depreciation is what our company calculated. So we add that back. And then wear and tear is what SARS allows. And then we deduct that wear and tear. Okay, then we also have depreciation on the machinery. So again, the depreciation is what the company calculated. So we add that back. Wear and tear is what SARS allows. So that's deducted. Then they sold one of the machinery. And the catch there, let's quickly go back to the question, where they tell you there at number 6 that there's machinery that was sold for 402,500 inclusive of VAT. So if they specifically tell you it's inclusive of VAT, then you have to exclude the VAT from that amount. Okay, if they don't tell you anything regarding VAT, we just go on as normal. But if they specifically tell you, like they did there, that amount is inclusive of VAT, you have to exclude the VAT. Okay, and it's only on the 402,500 that we exclude the VAT. Okay, so that 402 divided by 1.15 gives you then the selling price. And then we minus the 200,000. That's the carrying amount that the company have. And then on SARS's side, the selling price is also excluding VAT. And then SARS have that as 260,000. Okay, then there was also the credit losses. So that movement in allowance for credit losses, that's either the increase or the decrease. Then the opening balance is added back at 25%. We're back at the old 25%. And then the closing balance is deducted, and that's also at the 25% deduction. Okay, then there was also rent received in advance. Remember, they gave you the opening and the closing balance. So the opening balance is a negative, and then we add back the closing balance. Then there was also prepaid insurance. So there we add back the opening balance and we minus the closing balance. Okay, the reason is prepaid insurance is an asset, whereas rent received in advance is a liability. And then we can calculate the taxable income. And remember, for this question, your current tax was 27%. Hi, any questions there? Yeah, I think there the only catch was that VAT amount. But other than that, it's the normal depreciation that we always see. It's the credit losses that are always in there. The rent received in advance, the prepaid insurance. That's things that we mostly get in these questions. Sorry, that's completely the wrong paper. There we go. Okay, so that was question 2.1. So then at 2.2, this is then where they ask you the journal entries and where they give you the hint that your journals should include any provisional tax payments. Okay, so maybe those of you that don't really know, just let me give you a bit of background regarding provisional tax payments. Okay, so what will happen in your company after you've completed more or less 6 months of your current financial year? You will calculate what the profit is, just a sort of more or less. And then on that, you times that with 2, and then you get your profit for the year. And on that, you make provisional tax payments. Okay, provisional tax payments is done twice a year, end of August and the end of February. And that is just a more or less on what will happen with your taxes in the year. And then at the end of the year, you properly calculate your income tax, and then SARS will recalculate that to sort of then see where you are. Do you owe them more money, or do they actually owe you money that you've then overspent on your income tax? Okay, so these provisional tax payments that they've made is where we've paid towards our taxes, towards SARS, and we credit bank because it's money that we've actually paid. So you'll see there on the extract from the financial statements that they've given you, they're almost in the middle. We have a first provisional tax payment and a second provisional tax payment to SARS. Okay, so that's things that should go in there. So then your first journal can be your first provisional tax payment. So you'll see we debit our current taxation payable. If you don't really have SARS there in front, that's fine. It is a current taxation payable. And we credit bank, okay, because we are actually making this payment. Okay, and then we do the same for the second provisional tax payment. It's a current tax payable, 195,000, and we credit bank. Okay, then there's also an under provision. So you'll see there in the question, there at number 1, they tell us that the 2023 tax assessment was received on the 15th of February, and that reflected a current tax of 360,420. But the tax that was provided by the accountant was only 345,600. So the difference between the two is then an under provision, meaning we owe SARS more taxes than what we've actually calculated. Okay, so then that journal will be you debit your current tax expense because we need to pay them more. We credit current tax payable, and that's then the recording of the under provision of the current tax in the prior year. Fine. Then we also have to do the current tax that we've just calculated, the recognition of the current tax for the year. So that's what we calculated in 1.1. Okay, and then there's also the recognition of the deferred tax movement for the year. Okay, let's just quickly jump back to the question. There, right at the bottom of the extract from the statement, you have your deferred tax liability. So there you can see the difference between the 2023 year and the 2024 year. Okay, so that's where we get that tax movement amount from. Okay, and it's an increase in the liability. So that's why we credit the deferred tax from the statement of financial position, and we debit the deferred tax expense. Okay, any questions there before we continue? Okay, all fine so far. Okay, I think let's take a break again. I'll give you a 15-minute break, so until 10:30. You've almost survived 2 hours, so I think you need a proper break. So then at 10:30, we will then continue again. Okay, so the same thing as earlier on. If you have questions, you're more than welcome to put it there in the chat, but I will then only respond to that after the break. Okay, so that everyone can just hear the response as well. Okay, then we talk about at 10:30. Okay, let's continue then for the last session. Okay, so I'm sharing my screen again. Okay, so we had a look at 2.1 where we had to calculate the current tax expense. And then we did 2.2 where we had to do the journals. And then just remember, if they give you a hint, have a look at what that hint is telling you. Okay, it's not there just for summer. It's there for a specific reason. Okay, and then at 2.3, they ask us to do the income tax expense note, including the tax reconciliation. No comparisons, the tax rate reconciliation should be in Rand, but then they do ask you to show the effective tax rate. Okay, that effective tax rate is actually when you do it in percentages. Okay, but there is a way that you can just calculate the tax rate. You don't have to show each and every one as a percentage. Okay, so the note is the income tax expense note, and it starts with the major components of tax expense. So we had the current tax expense, then we had the deferred tax, and remember in this case you can use the temporary differences because we didn't do that full table where we calculated the deferred tax. And then remember in this question we had an under provision. Okay, so if it's an under provision, it's added. If it was over provision, then we will deduct the amount. Okay, then the reconciliation. So remember, we take the net profit before tax, and then we calculate tax on that. So at 27%. And then all the exempt or then permanent differences. So we had the depreciation, we had the fines, we had the dividends received. All of this is also the tax portion. And then we also have to add the under provision. Okay, and then they've asked us to show the effective tax rate. And then to do that is you take the total that you've calculated there, the 497,580, divided by the net profit before tax. And then we times that with 100, and then you get your effective tax rate. Okay. Any questions there before we go to question 3? Okay, so just to quickly clarify that that we spoke about earlier on, that 801,050 on the 2025 paper. I did have a look at that now, and yes, it's not balancing. So I think definitely there was a mistake in the question that they didn't really realize. It was only when the lecturer started marking that we've seen, but there's two things that's not on the reconciliation. Okay, so that will then be an exception to the rule. So it's not going to balance, but normally it should balance. Okay, so just to get back to you on that. Okay, so then the last question was then question 3 for 10 marks. Skylar Pty Limited is a manufacturing company operating in the Greater Johannesburg. On the 1st of March 2023, the company acquired a patent for 150,000 Rand to be used for the manufacturing a special hybrid system. The patent is for a period of 20 years. That's the useful life. SARS allows a 10% tax allowance on a patent asset. A tax rate of 27% applies for the year ended 29 Feb 2024. And then at the required part, they ask you discuss with supporting calculations the measurement of the deferred tax in relation to the patent for the year ended 29 Feb 2024. And then again, they give you a hint. Include the conceptual meaning of the carrying amount and tax base of the patent in your answer. Okay, so this was a very theoretical question, but they did ask you for supporting calculations. So please don't forget that. Okay, so you can have something like this. The carrying amount of the patent represents the amount that will be recovered in the form of economic benefits that will flow to the entity in future periods. In this case, the economic benefit will be generated by means of using the patent. Okay, and then you calculate the carrying amount. Because remember, the hint was to sort of discuss what the carrying amount and the tax base is. And in the question, they told you that it depreciates or amortized for 20 years. And then the tax base of the patent is the amount that will be deductible for tax purposes against the future taxable economic benefits. And that was then at 10%. Okay, so there you've calculated the carrying amount, you've calculated the tax base. And then as the carrying amount of the patent exceeds its tax base, the future taxable economic benefit exceeds the amount that will be allowed as a deduction for tax purposes. The difference is a taxable temporary difference, and the payment of the resulting income taxes in future periods are recognized as a deferred tax liability. Then the temporary difference, oh, sorry about that. So that's the carrying amount minus the tax base gives you a temporary difference. And on that, we calculate a 27% tax liability. Now, you can also then, if you want to do this in that table, there was no specific how you need to calculate this. Okay, so if you then do it in the table, that's also perfectly fine. Okay, and that was the 2024 paper. Okay, any questions there? Okay, so you can see we are now very early, but we are done. I will still be in the session, so please, if you have questions or you need help or anything, please feel free to ask. Sorry, I quickly want to see. I want to see if I can't attach the slides for you that you already have that. Okay, no, I can't. Okay, so the slides will then be shared to your lecturers, which will then share it to you. So I will quickly show the last 3 slides for you again. Okay, so the question was to discuss the deferred tax in relation to the patent. So it's best to start then with calculating your carrying amount and then your tax base. And then the difference between the carrying amount and the tax base is your temporary difference. And on that, we then calculate deferred tax. Okay, do you need a better explanation than that? Okay. Okay, if you need a better explanation, then I will. But I was just wondering if you just sort of don't want to just see that again. Okay, so as I've said before, I will still be here. We have another about 40 minutes. So please, if you want to ask questions, you're more than welcome to do so. But the recording will be on the YouTube channel, let's say by the end of today. Okay, and then the slides I will share with your lecturers now. So hopefully as soon as possible, they will then also, I think they'll put it on ARC. I think that will be the best. But other than that, you're welcome to send me an email and then I will also share the slides with you. So it will be the 2025 memo and then the 2024 memo. Okay, so thanks for the session. Thanks for actually being here. I know you are writing financial management tomorrow, so good luck with that as well. And then we'll speak again for test 2 and the exam. Okay, so good luck. And yeah, if you have questions, please feel free to ask. I will be here for another 40 minutes.